Welcome to this video on journal entries. We're going to be discussing the Zen of accounting, where every debit there must be a credit. But before we do that, let's review our account types. First, we have assets. Assets are something that you have or own. They have normal debit balances, which means debits increase and credits decrease. These would be things like cash, accounts receivable, supplies, equipment, building, machinery, things that we have and own. Then we have liabilities. Liabilities are something that we owe to a non-owner. Typically, these are identified as ending in the word payable because we must pay someone. These have normal credit balances, which means that credit will increase and debit will decrease. Notice that's opposite the way assets work. Equity is something you owe to an owner or the value of the business to the owner. Currently, you have learned common stock and retained earnings accounts. They have normal credit balances just like liabilities. So credit will increase and debit will decrease. The reason they have opposite normal balances from assets is because of the accounting equation. Remember, assets must equal liabilities and equity. But we have more. We have revenues. Revenue is the value of work performed either in providing a service or providing a product. Remember, the key to this is you have to do the work, not whether or not you were paid. This has a normal credit balance, so a credit will increase and a debit will decrease. Expenses are costs of doing business. Typically, these will end with the word expense: rent expense, salaries expense, utilities expense, insurance expense. They have normal debit balances, so they work opposite the way revenues do because they reduce revenue to come up with net income. They have normal debit balances, so debit's going to increase and credit's going to decrease. Now we're going to look at some transactions and we're going to put those into journal entries. But we need to review journal entry rules. With a journal entry, we always need at least one debit and at least one credit. We can have more, but we need at least one debit and at least one credit for every transaction. Debits are always listed first. Credits are listed after the debits. The order within the debits and credits don't matter as long as debits come first and credits come after the debits. The total number of debits, the total dollar amount of debits, and the total dollar amount of credits for every transaction has to agree. First transaction. The owner started a new business called Accounting Rules and invests $100,000 to get started. You always want to look at this from the company's perspective. So from the company's perspective, what is the company getting? The company is getting cash, right? We refer to anytime we receive money as cash. It could also be referred to as a checking account. That's fine as well. And why are we getting cash? We are getting cash because the owner is investing. When the owner invests in a corporation, the owner receives common stock. So now we know our accounts. That's one part of what we need to know. We need to know their account types. Cash is something that we have or own, so that means it's an asset. We want to increase it since we're receiving cash, so we're going to debit. Common stock, that is something the owner gets, so it's something we owe to the owner, so that makes it equity. We want to increase the value of the owner's investment, so we're going to increase that as well. We increase equity with a credit. This is how the journal entry would look. We would debit cash for $100,000 since that's the amount of money we received, and we would credit common stock for $100,000. So we have one debit and one credit, and both of them match or agree. Next transaction. We purchased a building by paying $2,000 cash and signing a note for the $100,000 difference. What happened in this transaction? What did the company get? The company got a building. What type of account would a building be? It's going to be an asset. How did we pay for this building? We paid $2,000 in cash, and we signed a note for the difference. When we sign a note, that means we're going to pay it later. Anytime that we pay it later, it becomes a liability. We will call this one note payable because we had to sign a note. So we want to increase the asset. We do that with the debit. We want to decrease our cash because we paid out cash, which means we no longer have it. And for notes payable, we want to increase our debt. So we want to increase the liability. So we have two assets and a liability in this transaction. In a journal entry, it would look like this. We would debit the building for the total value of the building, which is the $100,000 and the $2,000 combined. So the total building amount is $102,000. We debit the building, we credit cash because we want to decrease cash, and we credit notes payable because it's a liability that we want to increase. Transaction 3. We purchased office supplies for $500 on credit. When you see on credit, that's one of those keywords that means it hasn't been paid for. If it's us, the company, who needs to pay it, it's going to be recorded as accounts payable. If it's a customer who did not pay for services we provided, we're going to receive money from them in the future. It's accounts receivable. So when the company has to pay, it's payable. And in this case, we purchased office supplies for $500 on credit. What did the company get? The company got office supplies. How did we pay for it? On credit. The simplest example of that is a credit card, but we call it accounts payable. So, office supplies is an asset. We want to increase what we have, so we're going to debit. Accounts payable is a liability. We want to increase what we owe, so we want to increase that with a credit. The journal entry would look like this. A debit to office supplies for $500 and a credit to accounts payable for $500. Notice how all of our credits are moved over or indented so that we can easily separate them from the debits. Transaction 4. We did work for a customer worth $5,000 and we received payment immediately. Whenever we do work, remember what that's called? That's called revenue. So we did work. Did we receive payment for it? Yes, we received payment, and when we receive payment, we receive cash, or we record it as cash or checking. So we want to increase our revenue. Revenue has a normal credit balance, and we want to increase our cash because we're receiving cash. So my journal entry would be a debit to cash for $5,000 and a credit to service revenue for $5,000. Transaction 5. We paid employees $1,200 for salaries. So what happened in this transaction? The employees did work. It's a cost of our doing business, which makes it an expense. So we call this salary expense. How do we pay them? We give them a check or cash. We want to increase the cost of doing business for salaries, and we want to decrease our cash since that's how we're paying them. The journal entry would be a debit to salary expense for $1,200 and a credit to cash for $1,200. In transaction 6, we did work for a customer that was worth $10,000 with payment to be received within 30 days. So we did work for the customer, but we have not received payment. We are going to receive payment in the future. So we have our service revenue because we did our part. We did the work. The customer has not paid us yet. We're going to receive it later, so we will call that accounts receivable. Accounts receivable is an asset because it is something that we have or own because we will have that money in the future, or we should hope to. So we want to increase our service revenue, and we also want to increase something that we have or own. The journal entry would be a debit to accounts receivable for $10,000 and a credit to service revenue for $10,000. Transaction 7. We paid $200 on the office supplies purchased in Transaction 3. Remember, in Transaction 3, we purchased office supplies on credit. In this transaction, we are not buying new office supplies. We are simply paying off our debt. So we need to reduce cash, and we need to reduce our liability, accounts payable. So we want to decrease or credit cash, and we want to decrease or debit accounts payable. Since accounts payable is a liability and cash is an asset, they work opposite of one another. Our journal entry would be a debit to accounts payable for $200 and a credit to cash for $200. Few more. Transaction 8. We received the electric bill due next month for $150. So what happened in this transaction? We received a utility bill or electric bill. So we want to increase the cost of doing business for utilities. Are we paying it now? No, we just received a bill. We're not going to pay it until next time. So we are going to pay it later, which means accounts payable. So we want to increase our cost of doing business, and we want to increase our debt. Our journal entry would be a debit to utilities expense for $150 and a credit to accounts payable for $150. Transaction 9, we received and paid the telephone bill for $100. So we received a telephone bill, a cost of doing business, so that's an expense, and we paid it, so we're going to record a reduction to cash. We want to increase our cost of doing business, our expense, and we want to decrease our cash since we paid out our cash. We would debit telephone expense for $100 and we would credit cash for $100. Transaction 10. We received partial payment from the customer in the transaction number 6 of $3,000. We are not doing new work from the customer. The customer is just, we are receiving money from the customer. So we want to reduce the amount that we're going to receive from them in the future. So we need accounts receivable. And since we're getting cash, we're going to need our cash or checking account as well. We want to decrease what we're going to receive in the future because we're getting it now. So we want to increase cash. Our journal entry would be a debit to accounts receivable for $3,000 and a credit to cash for $3,000. So let's recap. We prepare journal entries from the company's perspective. What is happening within the company? What is the company getting? Remember the Zen of accounting. For every debit, there must be a credit. You can have more debit entries or more credit entries, but the totals must always agree. You must understand the normal balance of accounts. Assets and expenses have normal debit balances. Debits increase, credits decrease. Liabilities, equity, and revenue typically have credit balances. Credits increase and debits decrease. I hope this video helps. Be on the lookout for more videos to come.